Hi, welcome to Chapter 4, Cash Flow and Financial Planning. Now, in this chapter, we're going to talk about depreciation and its effect on cash flows. We're going to discuss the statement of cash flows, operating cash flows, and free cash flows. And we're going to try to understand the financial planning process, which includes long-term strategic plan, financial plans, and short-term operating financial plans. We're going to discuss the cash planning process and specifically how you prepare and evaluate the cash budget. We're going to explain the procedures to prepare and evaluate a pro forma financial statement and balance sheet. And we're going to evaluate and simplify the approaches to pro forma financial statement preparation and the common uses of the pro forma statements. Okay, so analyzing cash flow, a firm's cash flow. So this is really important because a firm, the cash flow is like the engine in their oil. So if the engine oil is running low, the engine's not going to perform well. It may seize or may completely stop the business operations. And too much oil in the engine is not a good thing either. It puts a little stress in the system and can damage certain parts. So cash flow really needs to be monitored closely to see its effects on business to make sure the business operates optimally. Now, from an accounting perspective, cash flow is summarized in the statement of cash flow. From a financial perspective, we want to focus on operating cash flow because this is the cash flow generated from the business and generated from management decisions. And we want to look at the free cash flow, which is closely monitored by many participants in the capital markets. So the free cash flow is looked at from investors as well as stakeholders and shareholders. Okay, so let's talk about depreciation. We all know the basic concept of depreciation. Depreciation is when something loses some value. So you have a brand new car and it's worth, say, $25,000, and then 5 years later, you're stunned to find out that you can't sell it for $25,000, and the dealer tells you, well, your car is depreciated. I can only trade it in for a value of $10,000. So where did that $15,000 of value go? Well, it depreciated along with the tires and the interior and the engine and the exterior. It's just not as valuable as it was when it was brand new. So in the accounting world, in the finance world, we get to recognize this and make some adjustments to our revenue. So it's a portion of the cost of fixed assets we can charge against the annual revenue over time. So depreciation, basically, when we want to take away the value of some assets, we can take it out of revenue. So if assets lose $100,000 of value through depreciation, we can reduce our revenue by $100,000. Now this is great for tax purposes because if we reduce our revenue, we're reducing the amount of taxes we pay because less revenue will turn to profits. Now, we use a system called Modified Accelerated Cost Recovery System, MACRS as an acronym. So there are other depreciation methods you may have learned, like dollar declining balances or straight average. That could be something that you talked about in an accounting class, but most financial people prefer this modified accelerated because we can deduct more money faster, which means we get to see our cash sooner. Let's take an example. Baker Corporation requires a new machine at a cost of $38,000. The installation cost is $2,000. So when the machine is retired from service, they expect to sell it for $1,000. Now these are three important pieces of information because the cost of the machine along with the installation becomes its depreciation base, or the total value that we can depreciate. And then if we're going to sell it for any money, that we have to account in as well because we can't take a deduction if we're actually sell the portion that we're able to sell and make money from. So what is depreciation value? It's the $38,000 of the cost and $2,000 of the installation base, and that's what we create the installation value that we can start deducting against. So depreciation value and depreciation life under the MACRS procedures, the depreciation value of the asset is its full cost, including any outlays for installation. So no adjustment is required for salvage value at that point. For tax purposes, the depreciation life of the asset is determined by this schedule, the MACRS schedule. And the property classes, there are different classes that assets fit in, and they go on to different year classes in the schedule. So you can have a 3-year asset, a 5-year, 7-year, or a 10-year asset. And there's certain definitions you can see. A 3-year could be research equipment, 5 years can be computers, copiers, printers, copy machines. 7 years could be office furniture, fixtures, and 10 years could be equipment and manufacturing equipment. Okay, so here's the schedule. Here is the actual schedule. Let me see if I could, being cut off at the top a little bit there. But these are the recovery years, and this is the 3, 5, 7, and 10 year. You'll notice that each year has an extra period. So this is because we could treat the first year and the last year as 6 months. So the first year is considered 6 months. The last period is considered 6 months as well. So we have 6 months, full year, 6 months. So if you add it all together, it's 3 years. 6 months and 6 months is 1 year, and then 2 full years is the 3 years. So we're going to break down the value of, if an asset fits in the 3-year category, it's going to be broken down 100% over these 4 years. And you'll see that the first 2 years, majority of the asset's value is deducted in the first 2 years of the life. And then later on, less and less of it's deducted. And that's why we like this for finance, because we get to deduct more sooner, which means we save more on our taxes sooner. And cash flows improve quicker. Okay, so this is a very important schedule. You'll need this to calculate and solve various problems that ask you to look at depreciation. Okay, so let's take an example. Here, the baker, remember when they acquired an asset, $38,000 plus $2,000 installations. The installation cost, the depreciation cost was $40,000 for the machine, and they're going to put it in a 5-year period. Now, you're never going to have to figure out what period the assets are going to fall into. All the problems will tell you use a 5-year or 7-year or 10-year, so you don't have to worry about that. It'll always state how many year schedule to use. In this period, we're using a 5-year schedule. So in the depreciate, we're going to take see these rates here, years 1 through 6, and these percentages. Where did these come from? This table. So you see these percentages for the 5-year, 20, 32, 19, 12, 12, 5. This schedule, we take these percentages here and we're placing them here. See the same percentages, and it equals to 100%. So we're going to take the 40,000, we're going to put that in the cost for every year. That doesn't change. And then we take a piece of that cost as depreciation every year. So 20% for the first year. So we just multiply 40,000 times 20%, 8,000. 40,000 times 32% for the second year is 12,000, and so on. If we add up all the depreciation, we get $40,000. So we have depreciated this asset 100%. And here's the little formula. Column 1 times column 2 equals column 3. And this is our depreciation schedule. So we've taken the asset and we've broken up into these depreciation chunks. Okay. So when developing a statement of cash flow, this is going to suggest the cash flow over a given period. And as discussed in the previous chapter, a statement of cash flow falls into 3 categories: operating costs, investment flows. I'm sorry, let me back up. Operating flows, investment flows, and financial flows. So operating flows are cash flows from the business. Investment flows are cash flows from investments that could be in fixed assets or equity investments, such as stocks in other companies, or financing activities, which is borrowing money. So it could be borrowing money in form of debt or equity. And these are the 3 categories where we break all the cash into. So an inflow, and this was also discussed in chapter 3, an inflow of cash is whenever we decrease an asset or increase a liability, we're getting an inflow of cash. Net profit after taxes, inflow of cash. Depreciation and other non-cash charges are an inflow, and sale of stock is an inflow of cash. Outflow of cash is any increase in asset because you use cash to buy the asset, and that's why it's an outflow. Decrease in liability because you use cash to pay off the liability. Reducing the liability means you're reducing your cash. Net losses reduce cash. Any dividends paid will reduce cash. Any repurchase or retirement of stock will reduce cash. Okay, so Baker Corporation income statement. So here's the income statement, and we have our sales revenue, less our costs, less our operating expenses, less our depreciation, less our taxes, less our preferred dividend, and we have our earnings per share. And this, again, we talked about income statements last chapter. But here's just an example of Baker's income statement. Now, If we look at their balance sheet, again, we have their current assets here, total current assets for 2015, our total liabilities and total equity. And you notice that this 3,200 is the same for each year as well as the 2014 2,900 because it has to balance. Okay, so let's look at the cash flow. I'm just going to fix this line here. Okay, that was bugging me. I just want to fix this so you can read this. Table 4.6, Corporation Statement of Cash Flow for 2015. And we see here that using information from the income statement and balance sheet, that's why we're displaying these up here, because we can use information from income statement and balance sheet to work on the statement of cash flow. So here, what we have is cash flow for operating activities. So we have our net profit after tax. Depreciation, you'll notice that this 180 and 100. Here's the 100 depreciation. For depreciation, here's the 180 for net profit. So this shouldn't be a mystery. These numbers are coming from those financial statements. Increase in accounts receivable. So where did this $100 increase in accounts receivable come from? If we go to accounts receivable, we see we went from, actually, it's a decrease in accounts receivable. We see we went from 500 in 2014 to 400 in 2015. So that's, if you're decreasing accounts receivable, you're collecting cash, and that's an increase to the cash flow statement. So we had a decrease in inventory. So a decrease in inventory means an increase in cash flow. So if we go back to inventories, we see that went from 900 to 600. So that means that we sold inventory and didn't replace it. We consider that as a increase in cash. We had an increase in accounts payable, which is an increase in cash, and a decrease in accruals, which is a decrease in cash. So cash provided by operating activities is $780. Now, cash flow from investments, we invested in fixed assets. We spent $300,000 on fixed assets, so that reduced our cash flow from investments. And cash flow from finance activities, we paid off $100 in notes payable. We took another $200 in long-term debt, and we paid a dividend of $80. So our cash provided from financing was $20. So we add the financing $20 to the negative $300 to the $7,800, and we get a cash flow increase in cash of $500. So that's the cash flow statement for this company. So basically, to create a cash flow statement, we look at the various items from the income statement and balance sheet, and we use them to create a cash flow statement. Now, if we want to interpret, this is where creating the cash flow statement is really up to the accountants. So financial people don't have to worry about creating the statement. We have to worry about interpreting the statement. So the cash flow statement ties together the balance sheet at the beginning of the period to the balance sheet at the end of the period. So that's why we have the balance sheet from 2014 to 2015. So we're looking at the change in the balance sheet to show us the change in cash. So this is, we're looking at the performance through this period, also on the income statement. So a net increase in cash or a net decrease in cash is going to affect the cash flow statement. So if we increase cash or marketable securities, this should be the equivalent of the difference between the cash and marketable securities on the balance sheet at the beginning of the year to the end of the year. So we have to look at, like I was showing you before, we look at the change. The change is what actually goes on the cash flow statement, because it's the change that's going to denote whether cash was spent or received. Okay, cash was gained or taken away. Okay, so the operating cash flow, this is a little formula to figure out the firm's operating cash flow. And that is the cash flow firm generates from normal operations, from the production and sale of goods and services. So this is really a barometer of how healthy the firm is. Because if a firm can't produce cash from its operations, it's sort of a sick business. So the first thing an analyst wants to know is the business generating cash. So if we look at NOPAT, which is net operating profits after tax, and we can calculate NOPAT by taking the EBIT, earnings before interest and tax, and you may want to know what is the EBIT, and EBIT is right here, earnings before interest and tax, EBIT. It's also known as operating income. Okay, and we multiply that by 1 minus the tax rate, and that gives us our NOPAT, which is our net operating profits after tax. So then we want to look at our net to get our operating cash flow, we just take our NOPAT and we add depreciation. We add back depreciation because it's a non-cash charge. We paid for the asset 10 years ago, and that's when the cash flow was affected. Now that we're just reducing by depreciation, no cash is really leaving the company, so we have to add that back, and that's how we get to our operational cash flow. And if you put this whole thing together, you could do EBIT times 1 minus T plus depreciation. That shows us our operating cash flow, which is the amount of cash the business is generating. Now, for example, if we look at the Baker's Corporation, we can take, and we saw before that the NOPAT was 370 times 1 minus 0.40, the tax rate, add 100 for the depreciation, and we get 222 plus another 100. So where is that other 100 coming from? All right. EBIT times 1 minus the tax rate plus 100. Okay, I'm not sure where that second 100 is coming from. It could be an error in the slide, but going by this formula, the NOPAT times 1 minus the tax plus the depreciation. Okay, so we can conclude that Baker's operating generated a positive cash flow from the business. Okay. All right, so let's look at free cash flow. So free cash flow is the amount of cash flow available to investors, creditors, and owners after the firm has met all operating needs and paid for investments in fixed assets. So this is sort of the next step, is we want to look at free cash flow, and this free cash flow is going to really look at the amount available to investors. So what we do here is we take the operating cash flow and we minus out the hold on one second. Okay, so if we look at this example, we see that for Baker Corporation, see this 370 and this 100, where is that coming from? If we go back, you see depreciation expense is 100, and earnings before interest and tax is 370. So that's where they're getting those numbers from. And they're taking the 370, 1 minus the tax rate, plus 100. So basically what that turns into, 370 times 0.6 is going to give you $222, plus the 100 from depreciation will give you $322. So that is the operating cash flow. And the cash flow is positive, so that's good for the business. Now let's turn our attention to free cash flow. So if we look at free cash flow, this is the amount of cash flow available to investors after the firm has met all its operating needs and paid for investments in the fixed assets. So this is really taking it one step further, and we're going to factor in the fixed assets. So we start with the operating cash flow, and we're going to subtract out the net fixed asset investment minus the net current asset investment. So what is the net fixed asset investment? It's changes in fixed assets plus depreciation. So we look at the changes in fixed assets minus changes in accounts payable plus accruals. So here, if we look at this formula, I'm sorry, I was describing the second formula, which is net current asset investment. So let me just restate that. The net fixed asset investment is just the changes in fixed assets plus depreciation. So when I say changes in fixed assets, see they listed here as 120 times 1200 minus 1000. So if you go back to the asset section, we see we want to look at, okay, we want to kind of match those numbers up. So here's the next net fixed assets. We get 1200 and 1000. That's where we're getting those numbers from. So it's the change. So it's how did the net fixed assets change? Well, it looks like we went from 1000 to 1200, so it changed by 200. So going back and looking at this formula, we put that money in here, and then we're going to add depreciation. We know depreciation is 100. So it's a $300 number here. Now, if we're going to look at change in current assets, we look at change in current assets minus change in accounts payable plus accruals. So again, here we go to the balance sheet this time, and we look at, just remember these numbers, total current assets, 12,000 and 1,900. And then if we look at accounts payable, notes payable and accruals, is that the two, accounts payable and accruals. So accounts payable and accruals, that would be 800 and then 700. Okay. So we come back here. Here's the 2,000 minus the 19,000, and then 800 minus the 700, which gives us a 0. So we looked at the change in assets and change in accounts payable plus accruals. So we had, this is assets 2015, current assets 2019. Remember, it's current assets. So that's a $100 difference. And we had, if you look at the accounts payable plus accruals, it's 800 minus 700, which is 0. So add these two together, we have we have 100 here, 100, and we have 100 here. Let's see, what is going on here? Sorry. Oh, minus. So this should really be, that's a little mistake here. So see, we have change in current assets minus change in accounts payable and accruals. So this sign here is a mistake. I have to fix that. Let me fix that. Okay, so that makes more sense. That was a little error in the sign. You see how it's clearly a little mistake, but it's fixed. Okay, so we have $100 here minus $100 here is 0. So we do the free cash flow. We take our NFAI minus our, we're taking the free cash flow. This is the, operating cash flow. Operating cash flow. Remember, we calculated that back here. Is our operating cash flow. So we take our operating cash flow, we minus our NFAI, and then we minus our NCAI, and we get $22. So thus, the firm generated adequate cash flow to cover all the operating costs, investment costs, and had free cash flow available to pay investors. So that would be the, when we talk about free cash flow, that's pretty much looking at everything. So that's the bottom line of cash flow. Okay, so let's focus on some practice here. Let's think about this again. Let's look at Cisco Systems. So on May 13th, 2010, Cisco Systems reported earnings per share of 42 cents for the most recent quarter. And that's ahead of Wall Street's expectations of 39%. So that's good. They beat expectations. In a subsequent analysis, one analyst observed that the 3 cents by which Cisco beat the street, 1 cent can be attributed to the fact that the quarter that was 14 weeks rather than 13 weeks. Another penny was attributed to the unusual tax gains, a one-time tax gain, and the third was classified somewhat vague as other income. So free cash flow is often considered more reliable as a measure of a company's income than reported earnings because it breaks it out with more detail. So what are some possible ways that corporate accountants might be able to change their earnings, portray a more favorable earnings statement? Yeah, they could play around. It's easier to play around with your profits and your earnings for a company. That's why investors always look at the cash flow, because you can't manipulate the cash flow like you can manipulate profits. And that's why cash flow is more important for analysts than profits, because profits can be manipulated as far as one-time charges, one-time tax advantages. So where they're coming from could be sort of sneaky places that really aren't showing what the business is doing. But cash flow will really detail what the business is doing. That's why cash flow is better. Okay, let's switch over to the financial planning process. So this is something you're doing in a Zoom simulation, and we're going to kind of tie the two here. So it begins with a long-term or strategic financial plan that in turn guides the formulation of short-term operating plus budgets. So, in the Zoom simulation, your long-term plan is to really grow the company significantly. But in the short term, you have to kind of look at how are you going to make your investments in operations and investment in advertising and investments in net assets, buying plants and operational investments. These are all things that should really have some sort of budget to it, some sort of review. So the two key aspects of financial planning are cash planning and profit planning. So if you're doing the Zoom simulation, like every company, you're trying to maximize your profits. So if you could do a little profit planning, you'll have a better idea where your profits are going. And that's what companies need to do. They have to make sure they understand where their cash is going so they could line up future, if they need to borrow money, they can start lining it up now, because you can't really do that last minute in a lot of cases. And you also want to plan your profits. Why? Because, Wall Street is expecting a certain amount of profits from your company, and they want some stability and they want some growth in your profits. So if you can plan them out a little bit better, you'll have a better reaction from Wall Street and a more predictable profit flow. Okay, so let's go back to long-term strategic plans. We want to lay out the action the company is anticipating and taking and getting involved with from anywhere from 2 to 10 years. What are they trying to do? Are they trying to expand their market share? Are they trying to buy a competitor? Are they trying to downsize? So we really need to know what their strategic plans are for the firm. So if the firm has a high degree of operating uncertainty, meaning they're not quite sure what's happening, they may want to have, there could be issues such as relatively short production cycles, that you may want to use shorter planning horizons if you have a type of business a little bit more volatile. And plans are one component of a company's integrated strategy or a long-term strategic plan, along with production and marketing plans that guide a company towards its achievement goals. Just like in the Zoom simulation, you have your strategic sales plan, and that has to go along with what your marketing and advertising costs are and how your production, the cars your production is building. So it's all tied together to achieve the goal of maximizing shareholders' wealth. Now, long-term financial plans have to consider a number of financial activities. Fixed asset investments. In the Zoom simulation, what you're doing, you would want to look at buying plants and buying operational investments. Buying new plants, that $10 million charge every time you do a new plant. That has to be looked at because you don't want to spend money in that area unless you need it. Research and development activities. This could be, in the Zoom simulation, this could be related to your operational investments on the production page, where you're buying new software, new equipment, things of that nature. Marketing and product development, when you are marketing, spending your sales dollars, and when you're developing the product on the sales page. Capital structure, which is from the finance page, and sources of finance, which is also from the finance page. Borrowing additional funds or retiring funds. So these plans are generally supported by a series of annual budgets and profit plans that the financial manager puts together. So let's look at ethics for a second. How much is a CEO worth? So the CEO of Home Depot, when he resigned in 2007, the Home Depot stock fell 8%. So his severance package was $210 million, including $55 million of life insurance coverage, reimbursement of $1.3 million of personal tax related to the life insurance policy, $50,000 to coverage legal fees, $33 million cash due July 3rd, 2007, an additional $18 million over 4 years in terms of his deal, sort of a package of accelerated stock options. And his family will receive healthcare benefits for the next 3 years. So do you think shareholder activists should have been upset with this severance package? Had the Home Depot stock performed much better under his leadership? Well, yeah, this is an excessive amount of compensation for one employee. No matter how much you can tie into the stock success, having more success in the stock definitely softens the blow. But either way you look, that this pay is just ridiculous. So is it really ethical to spend all this money on a CEO that comes out of the profits of the company? It seems a little excessive and ethically questionable. Something to think about. Okay, so the shorter term planning process, we're going to look at operating financial plans. And so the short-term operational financial plan specifies short-term actions and the anticipated impact of those actions. And you can kind of think about when you're doing the year in the Zoom simulation, planning out your year or your round, that's sort of a short-term planning. So key inputs would include the sales forecast, which you definitely do in the simulation, and other operating and financial planning data. Key outputs include operating budgets, cash budget, pro forma financial statements, and as you notice on the finance page, the pro forma financial statements are calculated for you. So what's basically happening in the simulation, let's see if I can try to call it up. Okay, so in the simulation here, you have your sales page. This is where you're doing your sales forecast that we talked about. You're designing the vehicle. The marketing is where you're allocating your marketing dollars. Production is where if you're buying production plants, that's an investment in fixed assets. 2 plants equal 20 million. And if I'm making operational investments, these are investments in the company's research and development, efficiency, production robots, new technologies. And then in the finance page, this is where we have our capital structure between long-term debt. Let's make this. Ooh, I don't necessarily want to do that. I just want to make it smaller. Bear with me. Sorry. Nope. Here we go. Sorry about that. I wanted to get this in here. Long-term, short-term debt, and stock equity. Issuing additional funds or retiring funds. This means borrowing money here, issuing stock, bonds, and equity. And this is retiring, paying back bonds, paying back equity. And here's the pro forma financial statement. So you see right now you have zeros in here because the pro forma financial statement, it needs data from your forecasts. So when you forecast your vehicles here, this is going to be what they're going to use to determine your pro forma financial statements. And this is what a company is doing. So by forecasting here, you're telling the accountants, this is what I expect to sell. And that means they're going to start putting that in the pro forma, saying this is going to be our revenue. And when you redesign your vehicles, what you're doing here is creating a vehicle, putting a price on it, and all this information is going to be used to calculate your profits, your costs, the cost of inventory, the operating profits. So as you're designing these vehicles, what you're basically doing is you're coming up with your estimate of how you're going to design the vehicles, and that's going to show material and labor costs, and this is your cost of goods sold. That's going to be put into your pro forma. When you come up with a sales price on your vehicle, it's going to multiply your sales price times your sales forecast to come up with your revenues or sales for the period. So this is why, one of the reasons we do this simulation is so we could tie in some activities as if you were running a real company. And then you could see how these activities translate into the world of finance. You have a reference point when you are working on this material from the chapters. So you have a good idea of, what's happening. Okay, so bad value. When I say what's happening, you have a better idea of what we're trying to do in class and how that relates to a business because you're doing something similar in your business. All right, and I'm just putting in the numbers here to get this moving. Okay, so I'm going to submit my sales data. So now if we go and look at the Pro Forma tab, you'll see that sales have been filled in. Cost of goods sold have been filled in. And calculated my gross profits. These are all estimates. If I don't sell every vehicle I forecasted, this will change. That's why the pro forma is an estimated next year's guess of what my financial statement should be based on what the financial managers are putting together. And you'll see here there's 0 advertising costs. Where does that come in? Well, when I start doing my marketing and I start allocating my advertising. So let me just kind of put some advertising costs in here. Okay, so I put 8 million advertising costs in here, and I'm going to submit that. And you'll see on the finance page, now I'll have advertising costs in the pro forma. See my advertising costs pop in here. The general and administration expense, they figure out a percentage that applies to my revenue. So they calculated a percentage saying that SG&A is usually this percentage of sales. So it's a percentage of sales method they're using to calculate the pro forma financial statements. As I read in the student user guide, they explain that. So fixed cost. Okay, so if we look at the let's just go back to the finance page. And what we're going to look at here is two things we want to be interested in. Is we just discovered that our marketing goes in there, and the fixed costs. The fixed costs are going to be a percentage of our costs, our assets, our net assets. So let me just go back down to the balance sheet here. So we want to look at our total fixed assets and our fixed assets, depreciation, and total fixed assets. So what we want to do is that number is not going to be correct until we go into production here. We're going to buy some additional plants. So if we look at these 30 million here, we're spending 30 million, so that's going to affect our pro forma financial statements. So if we go back here, we'll see now under fixed assets, we're up 30 million. So we see fixed assets, remember we had 3 plants at the cost of 30 million. We'll see our fixed assets increase from 130 to 160. And our accumulated depreciation, they're calculating this. This is explained by the student user guide as well. Depreciation is a calculation that they derive based on the size of our fixed assets. But as our fixed assets increase, our depreciation increases. So we have our total fixed assets. Now, our inventory is 0 because we're forecasting and we're building exactly to the forecast. So we're saying we should not have any unsold vehicles, and that's why our inventory is 0. However, if we do develop an inventory, so this inventory here of 9 million, this is from last year, that comes from unsold inventory. So you see here, I had inventory left over, so that was not planned on the pro forma, but it developed because I had unsold cars. So here I'm saying I'm going to sell everything I make, like you say every round. But if you have any unsold vehicles, your inventory will increase. Okay, so back up here. So now our fixed costs are a percentage of our fixed assets, and depreciation expense is the increase in depreciation. So see, we went from 17 to 25. That's a 17.3 to 25.3 is an $8 million increase in depreciation expense, and that gets logged up here. So then we have our operating expenses, our EBT, less interest, and interest is calculated from when you borrow money here, there's an interest rate percentage. So this is the amount of percentage that we're paying on our loans, and as we borrow more, if we borrow more money, we see that our interest rate goes up, and we'll see that our interest expense goes up too. So you see here it's 2781. If I change this to only borrowing 1 million, you see our interest rate here goes down because I'm borrowing less, and we'll see that our interest is now also, instead of 21, it's 17. So the interest expense went down. So you see how it's all connected, and we have a fixed profit. We have our net profits. Our taxes are fixed at 30%, and we have our estimated net profit. Okay, and again, the cash. This cash is coming from. We keep a cash balance of 25 million. So we end with 25 million as our cash balance. We start with 25 million with our cash balance. So any excess or excess cash we build up. So if we figure out our change in accounts receivable and our total fixed assets, and we look at our total liability and owner's equity, we notice there's about an $80,000 difference between total assets and total liabilities and equity. That's our excess surplus cash. If you took this 81 million and you added the cash up here, then the balance sheet would balance, as explained right here. Okay, so again, this pro forma financial statement is based on my estimated production purchases. And if I was actually going to buy, say I'm going to buy 10 levels of a $20 million additional investment of operating investments, you'll see that that's going to go into our fixed assets as well. So now instead of being up 30, we're up 50, which increases our fixed costs and increases our depreciation, which also increases our depreciation expense. So you see everything you do in the simulation, and it reduces our cash because I'm using money to pay for operational investments. That's going to reduce my cash because I'm increasing a net asset. So you see how this is all tied together? Okay, and that's what you should be doing, in the simulation. when you make these changes in your plans, it's affecting your pro forma financial statement. Okay. All right. So this is why we do the sales forecast. Operating and financial data are the key inputs. So whatever you're typing into the Zoom simulation are your key inputs. Outputs are going to be the budgets, the cash budget, and pro forma financial statement. So there's no cash budget in the Zoom simulation, but there is a pro forma financial statement, which I just showed you, and I showed you how it connects to the decisions you make in the simulation. So when you are changing key inputs in the simulation, the pro forma financial statement is changing as well. And remember, the pro forma financial statement is next year's guess at what our profits and financial statements will look like based on the planning for this year. So to recap, when you fill out the Zoom simulation, you put your entries in sales, marketing, operations, and finance, you're basically creating a short-term financial plan. And these key inputs in your short-term financial plan are creating the output of the pro forma financial statement. So that's how the simulation generates that pro forma, and that's a guess of what the financial statement should look like next year. Now, if you don't sell every vehicle you forecasted to sell, their pro forma financial statement will not match your actual financial statement once the round is calculated, and that's how you sometimes develop an unexpected deficit because you didn't sell every car you expected to sell. Oops. Okay. Let's go back here. So the process is described graphically in this slide. So sales forecast. This is basically our sales page. So our sales forecast, we need to have information is needed on what the sales forecast is, and that inside that will include our marketing and advertising budget. And then that's going to translate into production plans. So the amount that we forecast needs to be matched up with the amount that we're going to produce in the production department. The same thing you're doing in the simulation. And then once we have those pieces of information, we can develop a pro forma financial statement. And the pro forma financial statement can be used to help create a cash budget. So long-term and short-term, long-term financing plans and fixed asset outlay plans are part of the cash budget. So the current period balance sheet is an input into the pro forma financial statement balance sheet. So we take the pro forma income statement along with the current period balance sheet to create the pro forma balance sheet. And the pro forma balance sheet is going to take information from the cash budget, information from the fixed asset outlay plan, and information from the long-term financial planning. So this is how kind of a graphical layout of how the information is going to flow when you're doing your financial planning. And a lot of this you can tie directly to the simulation when you're doing your sales forecasting and your marketing, your production, operations, and that's developing a pro forma financial income statement. And then the cash borrowing that you make on the finance page is going to influence the cash budget. And using the current balance sheet, we create a pro forma balance sheet. So back, to the simulation, it is creating, if I'm going to borrow, so if we go down here to the financial statement, you'll see that liabilities and equity, borrowing money up here or retiring funds. So let's borrow some money. So if we borrow money, and we'll see that our amount of liabilities have increased, the short-term and long-term liabilities have increased. And then if we want to look at the equity, we have 287 in equity. If we issue some stock, we'll see that now the equity section has changed because we're issuing more stock. And let's go back to the slide. That's how these financing activities are going to affect the balance sheet, because whatever you borrow in equity or debt is going to be placed in the balance sheet. And it has to also be included in the cash budget. So let's look at the process for short-term operational financial planning. So as indicated in that previous flow chart, short-term financial planning begins with the sales forecast, just like our simulation begins with the sales forecast. And the sales forecast is what's going to affect production plans. How many cars are we going to develop? How many factories do we need? And from that, our production plans would develop how much direct labor we're using, the factory overhead, which is a fixed costs, the operating expenses estimated for development, And then from this information we're going to use to create the pro forma financial statement. So when it says here, the factory overhead, that's basically on the simulation when we have these fixed costs. Back up here, we have these fixed costs. These fixed costs increase as you have more and more factories, because that is basically your factory overhead. What is factory overhead? Electric, taxes, everything it takes to run the factory, the cost of the factory is going to be a fixed cost. We call that an overhead. And from this information, we could calculate our pro forma income statement, and then cash budget can be prepared, and then we can use the cash budget to develop the pro forma balance sheet. So the first step, let's just step back to a personal finance example. So the first step here is define your goals. If you're going to do personal finance for yourself, what is your 1-year goal for your finances? What's your 2 to 5 year goal? And what's your 6-year plus goal? So if you're looking at these goals, so if you're a college senior, your immediate goal in 2016, we'll say, is to earn your master's degree or your bachelor's degree. So that's going to be a $40,000 cost. But by 2017, your long-term goal is to buy, so 40,000 is a cost, and by 2017, your long-term goal is to buy a condominium, the cost of $125,000. So, and so you can apply this to your personal life as far as how you want to look at what you're doing with your finances and your money from a short-term to a longer-term perspective. Okay. So let's forward to the cash planning budget. So the cash budgets. So we have the cash budget or the cash forecast. And it's a statement of the firm's planning of inflow and outflow of money, and it's going to use to estimate the short-term cash requirements for a business. So typically, the cash budget's designed to cover a 1-year period divided into smaller time intervals. So depending on the business, the more seasonal the business is, the more uncertain the cash flows will going to be, and the greater number of intervals you may need. Okay, so I'm going to stop here. This will be considered part 1 of chapter 4, and then I'm going to continue with the cash planning, the cash budgets as part 2.